Hey everyone, welcome back to the monthly market call for Valery. Going to talk a little bit about the market. Going to talk a little bit about elections. Going to talk not as much as I did last month about tariffs, simply because I feel like the short-term uncertainty is probably Canada's response to said tariffs, which is going to be determined by our election. And so we'll talk a little bit about that. I'm just going to get my presentation up here and we'll get into it. Just a quick about us. I know a majority of you listening in are real estate professionals. Valery is an AI company that sells real estate, and we try and help realtors get superpowers by using AI. AI, interestingly, is becoming more of a hiring decision than a technology decision, with a recent survey that said 37% of managers would rather hire AI than offer jobs to Gen Z. Regardless of how I feel about that morally, it is a data point worth thinking about. If you've read the Millionaire Real Estate Agent book, or even the Millionaire Real Estate Investor book, if you're one of the investors listening in, not a realtor, you'll note that one of the first key hires that you make in this industry is an administrator. And I think one of the things that Valery really offers to agents who are, kind of on the lower end of six figures, trying to make it to the higher end of six figures, is the opportunity to have that first key hire without having to make a hiring decision. I think technology is gradually playing a bigger and bigger role in replacing a lot of the things that we can do, and AI is just going to continue to do so. So if you're interested in learning more about how we can do that, I wanted to offer everybody on the call a free demo. You can just scan the QR code here to learn about our Valery Agent Assistant tool that we're working on. Just a quick summary on my vision for these calls. I really just want to help real estate professionals have the best understanding of the market that they possibly can to better advise their clients. That's really part of our vision here at this brokerage, is that part of our fiduciary duty is to help clients make a decision in their best interest. And the biggest key way that we can do that is aggregating and drawing conclusions from data as efficiently as possible, and how those factors can impact real estate. The key themes that I'm going to talk about today, and the key themes that I think for the next quarter, are tariffs, obviously, but I think my analysis on that was pretty much exhausted in the last month, and I don't think it needs more analysis. I think it's kind of just a waiting game, but it is still a key theme. We're kind of just waiting to see what happens on April 2nd, and then also segueing to the second key theme, which is the election that we're going to see in Canada, what Canada's response is going to be to that. And I'm going to talk a lot about the election today. I'm going to try to make it not political at all, but really goal here to be analyzing the range of potential outcomes, because that is how we model our decisions as real estate professionals, and how we can help our clients model their decisions as real estate professionals. And then the next one is recession, which I think, regardless of who gets elected, Canada is probably already in recessionary territory, and is likely going to continue to do so. This would happen independent of tariffs, although tariffs are likely going to exacerbate it. And the central bank is really in a hard spot, because we'll talk a little bit about it, but basically, a couple of economists are mentioning that they're kind of running out of room. We are seeing inflation heat up a little bit. And so the central bank in Canada is running out of room a little bit to cut, or to have further room to cut should we need a more strong response to any recessionary issues that we might see. So let's talk about uncertainty. So one of the key things that I want you to think about is, right now, I'm going to present a couple of charts that illustrate this to you, but right now we're seeing one of the worst starts to a housing market that we've ever seen in the GTA. And the reason for this is really because Canadians respond to uncertainty by pausing major purchase decisions. And so right now we have tariffs and not even, we don't even actually know if we have tariffs, but we have the threat of tariffs and the threat of tariffs that kind of comes and goes away every couple of months. And then we have an election, which will ultimately determine our response to those tariffs. And so we have a couple of different, like, let's call it milestones that will cross over the next little bit that will remove some of that uncertainty. So you've got your April 1st deadline, which is when Donald Trump has said that these new tariffs are going to happen. And then you've got your April 28th deadline, which is when Canadians are going to go to the polls and vote and decide who their next leader is to deal with said April 1st tariffs. Those two things, at least for the next 30 days, are going to result in basically pure uncertainty for the Canadian consumer. And so I would say I'd be very reluctant myself to be making any major purchase decisions. And I can totally understand why home buyers are also being very reluctant to make any major purchase decisions. The bigger concern from my perspective becomes that we are seeing a little bit of a resurrection of inflation, and we're seeing a potential recession, and that this could put us in sort of like a stagflationary territory. Not that I think that is a likely outcome. I think that probably will end up with disinflation or deflation as a result of recessionary outcomes. But short term, this is kind of a question or a word that's appearing again. And so when you have uncertainty combined with the potential for stagflation, it really just gives us a big question mark that I think the Canadian economy is dealing with right now. And we're really seeing that as the real estate industry, but also a lot of the Canadian economy kind of grinding to a halt until we have more data. We know who our leader is going to be. We know what the tariff situation and trade war situation is going to look like to make any decisions. And once you have those data points, we will be able to kind of go forward with our decision-making process. My goal today is kind of just to look at, okay, how is the market responding to this uncertainty? And then also, how can we kind of try and guide our clients and make decisions to cut through some of this uncertainty moving forward. So as mentioned, Canadians react to uncertainty by pausing their real estate purchase decisions. And so the easiest way to look at this is, you saw a rate hiking cycle and you saw a huge drop. This is Canadian Real Estate Association stats. You saw a huge drop in real estate transaction volume. And then we basically haven't seen a resurrection in real estate transaction volume until after the US election, or sorry, just before the US election, when, things felt kind of normal, right? We weren't really dealing with a lot of central bank volatility. Central banks started to cut again. And then, you got your November election, you got trade war threats, you've got Canada really being at the center of this trade war. And this has caused basically a collapse in transaction volumes again, heading into 2025. So I'm going to start off with the election, just to get the politics out of the way. So one of the key tools that I use to think about this is betting markets, right? And people who are basically putting their money on the odds of things. I think polls are good, but polls can change very quickly, and especially when, so you start to see response biases in certain voting groups that are just more likely to respond, and certain voting groups are just going to ignore it. If you've received a text message, as an example, think about yourself, whether or not you've responded to it or not, and whether or not your friends and other people in your voting group might do the same thing. And so the odds is really kind of the best way to look at this. I took the screenshot yesterday, but the odds are about 50-50 again today, with Carney kind of popping back up above Pierre Poilievre. And I don't really have an opinion on the outcome of the election. What I actually would say that Canada is very fortunate to have two relatively normal and decent candidates. So there I can upset all sides equally with that statement. But I think that the point of this is that we want to think about what would it look like if either of these individuals got voted in, because now all of a sudden we can actually be of value to our clients or to ourselves and to our own investment decisions in the next 30 days before that takes place. And we can say, okay, if I end up with Pierre Poilievre majority government, I would do this. And if I end up with a Mark Carney majority government, I would do this. And this is an important piece of investing and of being a professional in the space. I'm going to present kind of like a matrix on the likely outcomes that I could see and sort of like what would happen as a result of them. But basically, you've got a pretty close to equal chance that each of these parties wins a majority in the Canadian election. So sort of 28% chance on climbing that the Conservatives win a majority, 32% chance that Liberals win a majority. And so the higher percentage chance, like everything outside of that, is that we end up with a minority government. Liberals can actually form government likely with a minority, with an NDP coalition. Conservatives, it's kind of a question mark. We don't know whether or not they'd be able to form government. If anybody, they probably would be left to have a coalition with the Bloc, which I don't necessarily know if I see happening. So let's just kind of look at this range of potential outcomes and what would happen. So if we end up with like a CPC majority, which I would say, again, kind of 5 to 10% likelihood, you would get policy actually happening because they have the majority, and so they can actually get policy pushed through. And it would be rightist policy. So you would see it being destructive of inflation, cutting of expenses, social programs, taxes, etc. CPC minority, which is probably the most likely outcome at this point, although probably outcome with falling likelihood, would be probably the least progress we would see from a government, simply because they would likely be obstructed by their opposition, and they wouldn't be able to get policy passed. And any policy that did get passed would probably be centrist. It would be something that the other side would be agreeable to. I would say that the primary goal is to solve this trade war, and so I would say that as long as the ideas to do that are good, both parties will probably be pretty efficient at getting policy passed to do that. But I would say actually that it may be a little bit unfortunate. This is the highest likelihood outcome, simply because you'll need a pretty strong mandate and pretty strong action for either government, doesn't really matter, to deal with this trade war issue swiftly and efficiently from my perspective. And it's having kind of a strong opposition and a lot of political jockeying back and forth will probably prevent swift action from being taken place. Final two potential outcomes, let's say your LPC majority, so your Liberal Party majority. Again, you would see policy progress because you would have they would have a majority, and they would be able to get policy done. And it would probably be leftist policy, so probably a little bit more government spending, a little bit more fiscal dominance, which basically means the government can kind of outspend the central bank in creating inflation, or in their ability to reduce inflation. And especially with a central banker leading that party. I think if you ended up with a Liberal Party minority, they would probably form government with an NDP coalition, and so that might push the scope of policy that they're able to get passed a little bit more left than it would be if they were to get a majority government. So the next thing that you kind of want to look at is, and this is really rough, but more thought experiment that I think that you should do as an individual, and maybe have these thoughts with your clients, is where do each of these parties fall on key issues regarding housing? I'm not going to talk about stuff that I'm not qualified to talk about, because I just fortunate enough to have learned that lesson the hard way in the past. So which government is going to create more demand, and which government is going to reduce demand? The easiest way to think about demand is, the Bank of Canada observed it in their Q1 monetary policy report in 2024. Rent growth is driven by population growth. Population growth is driven by immigration, and immigration is basically, we have permanent residents, and then temporary foreign workers and non-permanent residents. We've had Pierre Poilievre come out and say that he is going to reduce immigration. We've had the Liberal Party bring on an advisor from the Century Initiative, which mathematically, if you look at it, would see Canada's population growing in like the mid 1% range per year, which is pretty much what we've seen for the past couple of years. Last year was like 3%, which most people seem to agree was high. 1% is not the 1% range is not something that is unheard of, but that's really our demand source in Canada is more people, less houses. And then the regulation side is kind of the other side of the coin, which is how much are we going to get out of the way of municipalities, home builders, et cetera. Like, let's call it cut red tape or build capacity to get more houses built. And I think Pierre's presented a lot of, I mean, he was housing minister during the Harper's term. We can probably borrow a lot of policy concepts. I imagine we'll see policies from both of these groups, and that would be a good time to revisit this thought experiment. Is who's going to stimulate demand more, who's going to stimulate supply more, and kind of move these parties up and down in where those might fall, so that you can establish sort of this box of, okay, I think we can safely assume that, we won't see a huge change in demand. Population growth might stay the same. It might come down a little bit, and we might see, either a small increase in regulation. Although I would actually imagine the Liberal Party will probably move to less and less regulation throughout the presentation of their platform, and then from this you can model what our housing market might look like under each government moving forward. The other piece that we've seen is tax cuts. So we've seen tax cuts from both the LPC and the Conservative Party of Canada. They came both on the same day, I think. Carney released his first, which was 1% tax cut, which results in about $250 savings. And the Conservative Party came back with different messaging. They made it sound like it was, not made it sound like, but it was a 15% reduction in the total tax burden for individuals. But it is really only a 2.25% cut to the tax rate. So you have basically, and I will say again, to kind of go back to the beginning of this, one of the benefits of a close election is that you have governments who are really pushing for policy and almost competing for policies that most benefit the end consumer. And so we basically have governments competing over who can impress us most with their tax cuts. And this basically modeled out, this chart here is how much money those tax cuts would save households based on their total annual family total income, ranging from kind of the $400 range for the CPCs to up to over $1,200 if you make over 180K. And similarly, I think it was about $250 in the lowest tax bracket for LPCs, up to about $600 in the highest tax bracket. The distribution of this is that the LPC's cut really would benefit more, have a more relative benefit on people towards the lower end of the income spectrum, and the CPCs would have a large benefit to people kind of in the middle or higher end of the income spectrum. Thinking more about the election specifically than policy, this election is really interesting, and it'll be important to observe as professionals to, again, try and model that potential outcome. Is that Canadians are going to decide based on the policy or issue positions of the parties more than their party loyalty. So in 2021 election, the policy or issue positions was the second most important thing to people, and so you can see here at the top, it was 28% of their decision-making process, and in the 2021 election, people were generally voting for the same party every election. That seems to have shifted. That party loyalty has kind of been blown open by, I think, a big divergence from the historic Liberal brand, maybe not the historic, but the Liberal brand of the past 8 years in Mark Carney, but also in a lot of people shifting their positions as a result of changes in the economy and policy over the last couple of years. And so it's been a big shakeup. There's a smaller amount that would decide based on the leader of the party, no real change in that regard. And so I would say that this is really going to be, and this is why I think polling is, and thinking about the election based on polling is very premature at this point. We still have 2 debates and a month of platforms to be released. And it sounds like what happens in the next 30 days is really going to decide how voters show up based on those policies or issue positions of the party. So the next thing is, what are those issues? And it's interesting because, I would have assumed that at the top of this list would have been the U.S. trade war and tariffs, but it's not. The cost of living is still a more important issue for Canadians than the U.S. trade war and tariffs, and they're probably both pretty related to one another. So that's worth thinking about as well. A little bit further down on the list, we have housing affordability, which is a pretty significant issue, as well as improving the economy. Healthcare is in there as well. I won't touch on that because I really know nothing about it. But to me, these economic themes are really going to be important on messaging for these parties, and I would pay very close attention to how they do that moving forward. One of the things that we're going to do is we're going to release very thorough analysis on housing policy and economic policy, and their and almost like a housing policy scorecard for each of these parties as it comes out. So stay tuned for that, and make sure if you just go to the valery.ca website and register, you will get on the email list, and we'll send that out as an email once it's out. So again, I want to bring your focus to this housing affordability thing, virtually unchanged in its importance between the last election. So I want you to think back to the 2021 election and how much we were talking about housing and how much progress has been made, or how much policy and maybe not progress depending on your perspective, but how much the policymakers have really been focusing on delivering results in that, or delivering policy ideas in that since the last election. Because it is still an equally important issue, actually slightly more important, but an issue of comparative importance as it was in the 2021 election. And then I want you to take that and multiply it by at least 2 for how important this cost of living thing is going to be for Canadians. And so we're really going to focus on cost of living and housing affordability in our analysis, simply because I know very little about global trade and U.S. trade war and tariffs. A lot of other people have been far better at analyzing that than I have. Thinking about that affordability side of things, we have record mortgage renewals taking place in 2025, and it's in an interesting position that we've ended up in. So this chart comes from the Bank of Canada, and it's fascinating to me. Repeat home buyers typically track below your first-time home buyers as their loan-to-income ratio. So they typically are spending less for their house relative to their income, or they have a smaller mortgage relative to their income. A lot of that's because they have accumulated equity that they can pull forward into their investment. But you'll notice how much tighter these lines got over the last little bit, and to the point where actually repeat home buyers for the first time are actually taking on more debt relative to their income than first-time home buyers. A lot of this, it could be that, well, a lot of it is those renewals where they didn't really have a choice and they have to kind of take whatever they can get. But a lot of it is also that first-time home buyers are kind of coming out of the market a little bit, or they're able to pause their decisions without any impact on their household borrowing. Whereas existing home buyers don't really have that luxury because they already own the asset and they need to continue servicing it. The newer data set, you can see that they're down a little bit, but as of the end of the original data set, the repeat home buyers were actually taking on more debt than your first-time home buyers. And then again, on your new data set, your first-time home buyers are lower than your repeat home buyers. Worth noting, because a lot of people make fun of, or like not make fun of, but are offended by investors and their role in the housing market. Investors have the lowest loan to income in the market. So they're actually taking on the least leverage relative to their income. And they're also the smallest part of the market. The next piece is looking at total credit trends. I would say like this looks alarming if you kind of just look at from the COVID peak to like the spike. But if you really look at it, if you kind of draw a line from the past low at the beginning before 2016 and draw it straight, it looks like we're kind of just returning to the long-term trend line. Not to say that that's a good thing, because any increase in borrowers falling behind on payments for at least 60 days is not something you want to see. But nonetheless, it looks more like a return to the long-term trend than some sort of an economic anomaly that's alarm sounding. That being said, I would say the recourse environment is definitely different. So banks aren't putting as much pressure on borrowers to fix these problems, and so we might, it's tough to say whether or not the data point is super positive. But all of that being said, my advice to you would be, when you see this, is not to panic, because mortgages after home equity lines of credit are the second lowest piece of that. So you've got mortgage, home equity lines of credit at the bottom, mortgages at the top, unsecured lines of credit above that, automobile loans above that. And again, these are only 0.67% delinquent, so less than 1% delinquent. Credit cards are hitting about a 1% delinquency rate, and installment loans are hitting a 2.28% delinquency rate. And so again, consumers are beginning to default on debt as of Q4 2024. Mortgages are increasing as a portion of that, but again, the sky is not falling yet. Not to say that it couldn't, but it's not yet. The one thing that I mentioned on tariffs that I think is worth thinking about is that the Bank of Canada modeled out potential pass-through of tariff costs to inflation. And not that, like, again, I don't really know a whole bunch about trade policy or, consumption or inflation and consumption, but simply that a sharper increase in inflation means that the Bank of Canada would have a lower ability to reduce rates until they can get inflation under control. And so, if we get a faster pass through, we end up with a short burst of inflation. So basically, if all of these companies that are charging the tariffs immediately mark their prices up by exactly the tariff amount, and the consumer pays it immediately, obviously that's a big increase in the inflation rate, because that's a jump up in price. Whereas if they kind of roll it out slowly, like they say, we're going to eat half of it. Let's say the prices go up by 20, the tariff is 20%, they increase prices by 10%, and they take a 10% hit. So they pay 10% of the tax. That would be kind of your middle scenario, where they kind of pass it through over 2 years. And then the other one would be where they pass it through over 3 years. The interesting part to think about this is that in the long-term outlook, you go all the way out to 2027, the ultimate lower inflation rate actually ends up coming from the faster pass-through of inflation, the faster pass-through of tariffs as inflation. And that's probably because you see a huge jump up in price, and then you see people be like, oh man, I can't afford anything anymore, and they stop buying, right? That's called demand destruction. If demand gets destroyed, then you'll see basically buyers stop buying stuff, and that causes prices to actually disinflate or even deflate, so come down or stop growing. Whereas the more spread out pass through of the inflation would actually lead to a more potential sticky inflation, and potentially, the longest pass through, the 3-year pass through, would be looks like a sticky and almost permanent inflation, where it seems to be flat at like a 0.5% increase. Whereas at least with your 2-year pass through, it's trending down towards the end. All of this to say that, Scotiabank's been pretty critical of the Bank of Canada lately, doesn't think that they're going to cut in the next meeting, thinks that they have overplayed their hand, and has kind of squandered their ability to respond to the trade war in this way because of the potential inflationary impacts of said trade war. Further potential negative impacts, which was observed by Kiel Institute for the World Economy, shows that Canada would actually see the largest drop in GDP around the world as a result of the 25% blanket tariffs across the world. because we're the biggest suppliers in the last monthly report. We are the biggest supplier of steel and aluminum to the U.S. by a very large margin. Report came out recently. No real good segue here, except maybe that tariffs make us sad. And happiness in Canada has fallen substantially. The plummeted piece is actually from CBC. It's not my title, so don't call me too bearish. But Canadian happiness has basically been falling since 2022. And if you look at it on a broader context, since 2015, where I think we ranked 5th as like the happiest countries in the world. We're now 18th. It's not all bad though. The US is apparently becoming unhappier at a faster rate than us, falling from just below us to 24th place. All of this to say that, economic disappointment is one of the biggest issues that Canadians have with the election coming up. And so I would just pay very close attention to your fellow Canadians. Don't be afraid to have those political conversations. They don't always have to have a political bias in them. Talk openly about policy and like what are good ideas to advance our country. And pay a lot of attention to that, because I think that the outcomes of those conversations and the things that you hear and observe are really going to be able to guide you more than anything I can say on a call like this, and anything that a chart can possibly communicate to you, simply because it's the spirit of Canadians that will decide the outcome of the election. That's kind of how democracy works. And I think that listening to a variety of voices as well as you can is actually going to help you predict the outcome better than any poll or any poly market odds might do. Okay, now we're done with politics, tariffs, and the election. Unfortunately, the market is not done with politics, tariffs, and the election. We actually saw the weakest start to the year that we've seen in 15 years. So this is the worst start to a spring market that we've seen in 15 years. To contextualize that, the only worst performance we've seen in a spring market was during lockdowns. And so the real estate profession is really struggling here. We're not seeing a lot of transactions. People really have no idea what to do. And frankly, they're really just looking for, buyers and sellers are looking for clarity. And they're waiting to see what happens. And we're really in a wait and see thing. And to be honest, I totally respect that. And I think that's the best place that our market could possibly be in right now. Do I think that this will continue into March? You'll probably still see more transactions into April. Do I think that we'll see an increase in transactions in April? Probably. We always do. People, we see a spring market. That's just typically when people like to prefer to buy and sell homes. I think we will see a spring market. It'll be a little bit higher than it is right now. It's not going to be a lot higher. It's still going to be subdued. I would say that this line will likely stay below, and it'll for probably most of the year until we've got some certainty, right? And if you look at your kind of COVID lockdowns as an example, you kind of had a big period of uncertainty, and then you had a lot of that demand, those 2 months of people who should have been buying, or 3 months of people who should have been buying. It very quickly gets back to its kind of long-term trend, because a lot of that demand gets pulled back, pent up, and then kind of slingshotted into the future. Probably the more concerning trend to look at is the active listings. By the way, I created all these charts on the Habistat. If you go to the habistat.com, if you're a Toronto Real Estate Board member, you can use it. It's a free tool that's available for members, included in your TREB fees. But active listings on the Toronto Real Estate Board, highest that they've been in at least the last 10 years. So you can see here we've basically started the year with really high number historically of active listings. Like the last time that we've seen active listings near this high would be your 2016 market. The other piece is that the total dollar volume, sales volume by region, you can see. So total dollar volume is kind of like your GDP of real estate, right? So the real estate market is distributing basically fewer commissions than we've ever seen. So real estate professionals are really tasked with how do we, how do we bring home as much money, put as much food on the table for our families as we did in the year prior. The big way you're seeing a lot of people pivoting to leasing. Leasing is still a pretty active market. You're seeing a lot of people make changes to their to maybe not their top line because we can't do so much, but also to their bottom line. Streamlining their businesses, hiring AI would be another good one. So there are a lot of themes right now, and it's not so much that I'm saying that to scare you about the real estate industry, but also just to think about if you're a real estate professional or whatever business you're in, think about the business decisions that you've made over the last little bit, how they've changed, and then kind of cast that out over the entire economy and say, this is the contraction that I think could happen over the next little bit in Canada. And that's probably an outcome that's worth modeling for. I think it's going to be a really tough year for most businesses, but especially for the real estate profession and probably for holders of property. I think people will be disappointed with the performance of the market this year. Lease prices are an interesting one. I think we are seeing a bit of a trend down in leases. I like to look at leases simply because they show us kind of like what the price floor of the market could be. Because, at the end of the day, your investor bid is your smallest bid, but it's probably also the last bid. Like at a certain point, if prices become compelling enough and everything cash flows, you will start to see, as you saw in the US, institutional capital start piling into Canadian real estate. You will start to see, your mom and pop investors start to pile into Canadian real estate the way that you've seen in the US as properties start to be able to service their debt and people feel that properties are discounted. Months of inventory is another interesting one. So I don't really look at months of inventory on a monthly basis. I look at it on a 3-month basis. This comes from the Habitat as well, but this is your 3-month rolling average months of inventory, and it's basically the highest that we've seen since 2016, which I think the longest that I have that data set for. And so you're as a professional who's representing buyers in this market, it's a really good buyer's market, honestly. Like, I mean, statistically, there are some questions around what constitutes a buyer's market, but I would say that by and large, we have entered a buyer's market, and I think that we should be treating it as such when we're representing sellers and when we're representing buyers. Terminations is another interesting one. You're seeing more and more people giving up on listing, or we're seeing the terminate and relist probably is another one. But either way, the volume of terminations is a very interesting data point to be looking at. And 2025 actually gave us the highest level of terminations that we've seen in the last 10 years. Median sale prices, interestingly, kind of trading sideways, slightly down, I would say, like in a slightly downtrend if you look at that whole channel. But if you look at the entire GTA, it's funny because, like, I'll give myself a pat on the back for this one. In 2022, I said, after the drop, I think the market will trade sideways for a couple of years. It has been a couple of years. It has traded sideways. I think I'm going to change my perspective now, given the economic headwinds, trade war, the setup for Canada economically. Probably a little bit more downside risk in the market than upside risk. But I am glad that I was right on the sideways market call for the past 2 years. That's all I got for you today. And I would encourage you, if you're a real estate professional watching this, and you want to see how else we can create value for you as a professional other than just spewing economic data at you, for you to have to be well armed with talking points for your clients, to book a demo with Valery's agent assistant. Just check out valery.ca/join-us or scan the QR code that's on your screen right now. I'll leave it up for now and field any potential questions that we might have from the audience. Can we get a copy of these graphs for emails to our clients? Yes, absolutely. We can send the deck. If you want to just send an email to Valery through the contact form. Melissa, I'll just send them to you because you and I are friends, but who else do I have here? Is it the right time to look for deals or still wait on the sidelines to see how the next few weeks get played? It's going to be longer than weeks. I would say it's always the right time to look for deals, and it's always a good time to buy a good deal. It's always a bad time to buy a bad deal, right? So when you've got a lot of supply sitting on the market, look, I've seen properties, you can see them on Treb. There's properties selling at 80% loan to value, or sorry, 80% of listing price. You wouldn't have gotten that unless you were out looking at properties and submitting offers. And it's not to say go lowball everything on the market, but it is to say that, if you think that the market's going to drop 10% or 20%, then, and you assume that properties are listed at their fair market value, which is a bold assumption, but let's just assume that for the thought experiment here. If I see a property and it's listed for $1 million, and I think it's actually worth $1 million today, but I think the market's going to drop 10% or 20%. Why don't I offer 20% less than what it's asked that it's listed for? It might piss some people off in the process, but that's usually how you get the good deals, is by not being afraid to hurt some people's feelings. And the reality is, real estate is one of the few assets that benefits from being held longer, simply because every month that goes by, you pay more principal and less opportunity cost. So let's call it rent. The asset, either if you own it as a homeowner, it pays you rent in such that you don't have to pay rent. If you own it as an investor, it pays you rent as a tenant would pay you rent. And so you get the yield, so almost like a dividend stock. Plus you get, if you can buy it at what we'll call its future value, if you think the market's going to come down 10%, plus you get the yield in the meantime, while you otherwise would have waited for the market to come down that 10%, then that's a really beneficial potential outcome. Nadia asked, is this presentation recorded, or will we get a copy of the slides? Yes, both are available. Please just send a message through the Valery website, and we'll get you a copy of the presentation. I think the recordings go up on the YouTube as well, and I'll see if we can find a place to just kind of host these on the website, so that we'll give you a QR code in next month's of all of the. Maybe I'll just make a blog post with all of the past months. PDFs of slides. Are there any other questions? Oh, there's a whole Q&A thing over here, eh? Is it a good idea to rent out our property for a while and then sell once things are clearer? Look, it's hard to give blanket advice on something like this. I would say the reality is we're in a market where the market's probably going to decide for you. I would list it for both sale and rent, and see which one ends up giving you the best result, to be honest with you. I think I don't think things are going to get clearer. Like, I think you're going to be waiting. I think you're going to be disappointed with how long it takes you to sell once things are clearer. Like, I don't see this being a short-term problem per se. Shins, I already answered. Is it the right time to look for deals? I think that's it. Well, thanks everyone. I really appreciate your time. Make sure you book a demo, share this with your friends. Feel free to invite as many people as you want to these things in the future, and look forward to seeing you next month, hopefully with an analysis of the amazing housing policies that we're going to look forward to in the next month. So